Hello and welcome to the second episode of Just a Tad. I'm Michele Levine, and TADs are GFOA's mini classes, 10 minutes or less, on an accounting topic. This episode is about revenue and expenditure recognition for the coronavirus state and local fiscal recovery funds, CSLFRF, still quite a mouthful, but a little bit shorter than the full name. We will, in this episode, quickly classify the CSLFRF grants. We'll review the rules for recognizing grant revenue in accordance with generally accepted accounting principles, GAAP, and on your schedule of expenditures of federal awards, or CFA, which is the foundation of a federal fund single audit. We'll explain a frequent source of confusion and then look at some model journal entries and CFA treatment over 2 years because cash receipts, eligible expenditures, and CFA recognition can cross between years. Lots of governments receive CSLFRF, right? A grant program established by the American Rescue Plan Act of 2021, affectionately called ARPA, right? And lots of the governments that got this money don't regularly receive a lot of federal funds. And if you don't spend more $750,000 or more of federal funds in a year, you don't have to have a federal fund single audit. But, even those governments that get plenty of federal funds, have single audits every year, were somewhat confused because there was nothing normal about this grant program, right? ARPA was passed in early March of 2021. Cash advances started going to governments as early as June of 2021. And the only thing that we had to guide us was what the U.S. Treasury Department called interim final rules. Quite an oxymoron, right? As well as frequently asked questions where the questions and the answers seem to change a lot. The final rule came out in January of 2022. So roughly 10 months after the legislation passed and more than 6 months after the cash started flowing. There are 4 kinds of non-exchange transactions, 2 of which are where we will find grants, including intergovernmental grant revenue. Now, because governments were forced to take these ARPA funds, this is a voluntary non-exchange transaction. But it doesn't really matter so much because all grants fall into roughly 2 categories, what we call and think of as purpose restricted and what we call expenditure driven. So we recognize revenue under GAAP when all of the eligibility requirements for the grant have been met. There are 4 kinds of eligibility requirements that can apply to a particular grant, right, based on the laws, the regulations, grant agreements, terms and conditions, etc. Right? Those that are subject to what we call reimbursement requirements are what we call expenditure-driven grants. So the problem is, it's not a great term because it's not really about reimbursement per se, so much as it is about the eligibility for the grant revenues being tied to a government having made, past tense, eligible expenditures. So key aspects of the CSLFRF final rule make it pretty clear that it is an expenditure-driven grant program because the eligibility requirements pretty prominently include the incurrence of eligible expenditures. That's pretty similar to the conclusion that the Governmental Accounting Standards Board reached in their 2020 technical bulletin with regard to governments that received the Coronavirus Relief Fund created by the CARES Act that year. So simply receiving the CSLFRF funds does not trigger revenue recognition in accordance with GAAP. Revenue from expenditure-driven grants cannot be recognized until the eligible expenditures have been incurred and identified. Now, that's not a term we usually hear in accordance with when we talk about grants, right? We just say incurred. But usually the identification process is part of the claiming for reimbursements, right? That's when we identify specific expenditures with the grant revenue. Well, because we got this cash in advance, it's sort of its own step. We have to incur eligible expenditures in order to recognize the revenue. And the CSLFRF final rule gave us several categories of eligible spending. One in particular, however, is causing a lot of confusion. So the amount that governments can use for this very broad category of government services, right, is set at either $10 million or at an amount that's calculated using a specific formula to determine the amount of revenue decline that affected the government during the pandemic emergency. So this is often called lost revenue. The fact that the amount is tied to lost revenue led some governments to kind of get confused and conclude that the loss of the revenue itself was the applicable eligibility requirement for the category. In fact, it's an expenditure-driven grant. So the expenditures for those eligible government services, that's what makes the government eligible for the grant. So let's take a look at some journal entries, right? If we received cash in year one, recognize the asset and the liability, but no revenue, because we've just received the cash in advance. Now, it's possible that we actually may have incurred some eligible expenditures in that year, but we hadn't made the final decision on how to allocate grant funds, so we didn't identify them as grant expenditures in year one. In year two, right, when we have all the final rules, etc., we make the decision on how we're going to allocate our grant funds, and we identify that those costs back from year one, right, were eligible, and we are going to use them, right, as government service costs for which we will use our grant revenue, right? So we recognize the grant revenue in year two, and of course, note that the assets are no longer restricted. Now, because we had not yet identified government services incurred as being expenditures of the grant revenue, there was nothing in year one of the CFA. In year two, however, when we make that connection, we'll recognize those expenditures of federal funds and put them on our CFA. Please watch for future episodes of Just a Tad and email us if you have a suggestion for a topic.